What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we're going to be talking more about cash secured puts, cover calls, what they are, and the more important thing for this video, the topic of the day, is when should I look at selling cash secured puts? When should I look at selling covered calls? So if you're excited for today's video or always just curious to know what Fridge Financials we'll be talking about, feel free, as always, to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. Now, in this channel here, what we're looking at for this portfolio for the day is we're up $360. We had a couple option plays here that worked out really nicely for us. So we're sitting in a really good spot right now at the time of recording this video. And again, over the last month, we have done a pretty good job being up almost 5%, which is absolutely awesome. 3 months still down, obviously, because we had a crazy sell-off, and then I went cash for a while and blah, 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 and all this kind of stuff. But don't worry about it. You know, we're on the grind back up, and I love it. And I'm feeling more and more comfortable and more confident in my trades. And that's what I want to have when I keep going forward here. So you're probably sitting here wondering, Fridge, I am here to learn about when should I sell cover calls? When do I sell cash secured puts? What's the reason behind it? What even are they? And how can I help you? And I got that. Okay. So what I want to do is I want to take an example of a stock like Enphase, for example. Okay. Enphase is a company that had a tremendous red day in the market. Okay. Down 19.63% at a low, was down about 22% before market opened. Then it seems like we got some buyers coming in, which is really nice. And what we're looking at here is Enphase sells off because the Trump administration has their tax bill going through. I think it made a little bit more progress today in Congress, or maybe it was the House, one of the two. And it seems like it's going to be impacting renewable energy, aka Enphase, right? So what you will notice is Fridge Financials sold a cash secured put. And what you will notice even more is that he sold the cash secured put as of 56 minutes ago at the time of recording this video. Right before market closed today, May 22nd, we sold this contract. Why? And what is the purpose of it? All right. So cash secured puts, in case you are wondering how this option works, and I'll go back down. I'm sorry if I'm hurting your eyes going back and forth. But so cash secured puts here, what we're looking at, where did it go? Hello? Oh, can I open it? Oh, yeah. Whatever. Let's go back to the portfolio. Let me pull it up this way just to make a point. God, it's just, mine's all over the place. All right. When you are selling a cash secured put, instead of being the option buyer and betting that Enphase goes down, the option seller is betting that Enphase won't go down, right? So right now, at the time of recording this, I'm betting that between now and May 30th, which is the strike price, Enphase will not go below $36 per share. If it does, I will buy 100 shares at $36 each, which is going to cost me $3,600. Now, it's called a cash secured put because you need to have the cash available, which I do in this portfolio. I have $3,600 available to buy the 100 shares if need be. Now, why would I sell this contract on a red day? Fridge is down 19%. What if it keeps going lower? When you are selling cash secured puts, at least in my experience and what I'm looking at here, cash secured puts are good to sell on red days. Cover calls are good to sell on green days. And here's an example as to why. If you look at the options chain, sell, put, Enphase, May 30th. If you look at the options chain, here's my contract right here. Now, before market open today, this contract was worth 1 penny per share, which equates to $100 because 100 times 1 penny is that $1. This contract was paying a premium of $1 because it was very, very unlikely to occur. But then hang on, Enphase comes in today, boom, sells off 19%. We're not too far now from the strike price of that, from the share price, $38, $36. And as your share price comes closer to that strike price, the probability of it hitting that price becomes higher. And there's more risk that you will have to buy the shares. If there's more risk, you got to pay me for that reward. Like, I'm not going to do it unless you give me some good incentive, right? So that's kind of the idea behind it. It's kind of just like the treasury market, the treasury bonds, believe it or not. Whereas if you've followed the news recently and we had the credit downgrade here, it's more risky to have to loan money to the U.S. economy. So what do they want in return? We want a better return, which is why treasury rates go up and everything. It's a whole different conversation, but kind of similar idea. If the risk is there, the reward has to be there as well. That's what this is talking about here. So why did I sell this option today? The option that would have paid you $1 now is going to pay me $69 because of how much it came down. The option premium, how much I get paid, went up 6,800%. And I'm capitalizing on that. Is it possible that end phase could come lower? Of course. I'm not saying it won't. But this contract, again, if I had this yesterday, it was worth $1. Now it's worth $69. That's a lot more premium for me. So I'm comfortable with selling options when the stocks come down. So, and also this one's pretty okay. The delta is 0.27, so 27% chance of it expiring at the strike price. But you're still looking at almost a 2% return on this trade by itself by next Friday. So when the market comes down and the stock prices come down, the premiums become juicier and juicier. And that's when you want to sell those cash secured puts because you can capitalize on the premium. I did the same thing with United Healthcare. When United Healthcare came down 15%, I was selling cash secured puts at like $250 and I was juicing the premiums because it was getting this volatility. It was getting nervous. People were freaking out and I was capitalizing on it. And that's what happens here. And that's what we like to do. Now, when is a good time to sell covered calls? I want to see if I can do it with block here, for example. Covered calls are good and they're useful when you own 100 shares of a stock. So if you had 100 shares of block, here's how this would work. And take a look as to why. If you go to trade options here and you sell a cash secured put here, same expiration date of next week, what you will notice that since XYZ, since block went up 5%, these became worth less because the strike price is a lot lower than the share price. The share price is moving higher away from that strike. So it becomes less probability. There's less probability of it happening, which makes it become worth less. So selling cash secured puts on a stock like Block that's up in the green today is not good because you're not capitalizing on that juicy premium. You actually have lost value. This contract has lost $1.92 per share as of today, which is $192 in premium. Okay, Fridge, what do I do with a company that goes green though? Let's say I have 100 shares of Block. What do you recommend I do? You sell a covered call. Because what happens here is that you are saying, I will sell my shares. For example, I will sell my shares at, let's go a month out because it's a little bit better that way. I want to sell my shares at $65. If Block goes to $65, I have to sell my 100 shares. But what do I get in return? I get the appreciation, the upside of Block from the share price, and I also get $97 in premium here as a result. Now, what you'll notice is that these became worth more because, again, as the share price moves up, it's the opposite of cash secured puts on red days. And on green days, as the share price is moving up, you're getting closer and closer to that strike price, which means that it's more likely for the contract to be exercised, which means that there's more risk, which means you need higher reward. So this contract right here is actually worth an extra $42 compared to yesterday. This contract here is worth $101 more compared to yesterday. On these green days, it is better to sell those covered calls. On the red days, it's cash secured puts. And that is the way to maximize your return and to maximize those profits on that option as a seller. So again, as a recap, this is a shorter video, but it's kind of breaking down some of the numbers, some of the logic here that we're looking at. When you have a nice green day on your stock, for example, another one would be like BTEL, which is a Bitcoin futures ETF. Again, what you will see is that these kind of strikes will actually go up in price, and you'll see they start to increase in value. If you wanted to go, to say June 30th, they increase in value because the share prices went up. This one went up 2%. Covered calls are good when your share prices go up. Share prices go up, boom, you sell your covered call. Stock prices come down, boom, you sell your cash secured put. And that's a way to maximize your options premium in the stock market. And if you don't mind owning the companies, you're just getting extra return for buying shares, and nobody will complain about that. So thank you guys so much for watching today's video. Again, a little bit of a shorter video, but kind of, again, summarizing the idea behind it. Selling cash secured puts on red days, selling covered calls on green days is a great way to maximize those returns. So thank you guys so much for watching. If you've made it this far, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads on the channel. I hope you guys are making money in the market, whether it's cash secured puts, covered calls, or even just interest on 4% like I am right here. Thank you guys so much, and I will see you guys, as always, in the next video.